Let me be brutally direct with you right now, because what I am about to tell you is not a prediction, and it is not a theory. It is a pattern that is repeated with mathematical precision 3 times in the last 100 years. A pattern that made a small number of people extraordinarily wealthy each time it played out, and a pattern that destroyed the savings of everyone who either did not see it coming or saw it coming and did nothing about it. That pattern is happening again right now, today, in 2026, and the overwhelming majority of investors watching this video are going to miss it exactly the way their parents and grandparents missed it before them. Not because they are not smart enough, because they are waiting for certainty. And certainty in financial markets always arrives 18 months after the window is already closed. I am going to give you a specific number in about 90 seconds that will tell you exactly where we are in this pattern right now. Stay with me, because this number changes everything. Subscribe to this channel right now, not at the end. Now, what I am giving you in this video is the kind of historical cycle analysis that Ray Dalio's Bridgewater Associates produces for sovereign wealth funds and central banks. I am handing it to you here for free. One click, subscribe, and then do not move. Here is the number. 3. 3 times in the last 100 years, the same specific configuration of forces has appeared simultaneously in the American economy. 3 times. And every single time, without a single exception, the same sequence of events followed. The people who understood the pattern compounded enormous wealth. The people who did not lost decades of purchasing power. We are in the 3rd recurrence right now, and I am going to show you exactly where we are in the sequence. But first, I need you to answer a question honestly. Think about the last time you made a significant change to how your money is positioned, not rebalancing inside the same asset classes. A genuine structural change based on where the macro environment was heading. If the honest answer is never or not recently, stay with me, because the pattern I am about to describe is the reason that answer needs to change before this year is over. The first time this pattern appeared was 1971. Richard Nixon ended the convertibility of the US dollar to gold under pressure from a debt load accumulated during the Vietnam War and Great Society spending programs. The government was spending more than it collected. Foreign creditors were losing confidence. The monetary system that had governed global finance since 1944 was restructured overnight. What happened next was not a crash in the traditional sense. It was a slow, sustained, mathematically inevitable erosion of the purchasing power of every dollar-denominated asset. Cash lost value every year for a decade. Long-duration bonds were devastated. The people who held paper assets denominated in a currency being deliberately devalued watched their real wealth shrink year after year, while the nominal numbers looked stable. But the people who understood what was happening, the ones who moved into gold, silver, energy, and real assets before the mainstream caught up, saw those assets multiply. Gold went from $35 to $850 in 9 years. Silver went from $150 to $50. Oil tripled. That was the first recurrence. The second time this pattern appeared was 2008. A debt cycle that had been building for 2 decades reached its structural limit. The government responded with the largest monetary stimulus in American history up to that point. Interest rates were slashed to 0. Trillions were printed. The dollar was deliberately weakened to reduce the real burden of the debt. And again, the people holding paper assets in dollar-denominated accounts lost real purchasing power, while the people holding hard assets, gold, commodities, real estate with genuine scarcity, came out ahead. Gold went from $700 to $1,900 over 3 years. That was the second recurrence. Now here is where I need you to pay very close attention, because this is the part of the video where most people nod along and then do nothing. And I want you to understand why doing nothing this time is categorically different from doing nothing before. The third recurrence is happening right now, and the scale of the forces driving it is larger than either of the previous two. The United States is carrying $40 trillion in national debt. Interest payments have crossed $1 trillion per year for the first time in history. The Treasury Secretary publicly called for a Bretton Woods realignment last month. Ray Dalio said on camera this week that we are already in a stagflationary period. The new Federal Reserve Chair is operating under maximum political pressure to cut rates at exactly the moment inflation is structurally sticky. Foreign central banks are selling U.S. Treasuries and buying gold at the fastest pace in 50 years. The UAE just left OPEC after 60 years. Saudi Arabia is negotiating oil contracts priced in Chinese renminbi. Every single one of these data points is a direct echo of the conditions that preceded the 1971 transition and the 2008 transition. The pattern is not similar. It is structurally identical. And the question I want you to sit with right now for 30 seconds before I tell you what comes next is this. If you had been shown this exact data in 1971 year before Nixon ended the gold standard, would you have done something different with your money? Think about that honestly, because that is the question your future self is going to ask you about 2026. Here is what the historical pattern tells you happens next, with documented precision. In the 12 to 18 months following the convergence of these 5 conditions, fiscal stress, monetary credibility loss, political paralysis, foreign creditor retreat, and stagflation, 4 things have happened in sequence every single time. First, the dollar weakens against real assets, not dramatically overnight, gradually and then suddenly. Second, gold and silver reprice significantly higher as paper assets lose purchasing power, and investors rotate into things that cannot be printed. Third, energy companies with structural pricing power outperform the broad market by significant margins because energy is the most reliable inflation pass-through asset in existence. Fourth, passive index fund investors who thought they were diversified discover they were concentrated in the exact assets most exposed to the transition. Technology stocks priced for a future that gets repriced. Long-duration bonds devastated by rising yields. Cash silently eroded by inflation, running above the interest it earns. This is not a forecast. This is the documented sequence from 1971 and from 2008, both times, without exception. Now here is the critical difference between 2026 and both previous recurrences. The speed. In 1971, information moved slowly. It took months for the implications of Nixon's decision to work through into asset prices. Individual investors had time to respond. In 2008, algorithmic trading was in its infancy. The repricing happened fast, but not instantaneously. Today, algorithmic systems control 60% of daily market volume. When the institutional consensus shifts, the repricing happens in days, not months. The window between when the pattern becomes undeniable and when the best of the move is already captured has compressed dramatically. The people who profited from 1971 had months to position. The people who will profit from 2026 have weeks, and most of them are watching this video right now. Here are the 3 moves that put you on the right side of the pattern. The first move is to immediately audit your real dollar exposure, not your nominal portfolio value.